from a lender's perspective, they might do the deals where, they'll fund the acquisition and the construction finance, but they want to ensure that at least the DA is in place, or at least the planning approval is in place. There are different terms between different states. So they want to ensure that the planning approval is there before they put their neck on the line and, give you any sort of funding. So that's very, very important. You're listening to Help Me Buy Property podcast, powered by Investor Partner Group. We help improve lifestyles by building scalable and sustainable generational wealth and passive income streams. We do this via our ecosystem that is a one-stop shop to all property investment needs, from evidence-based, data-driven buyer's agency, industry-renowned portfolio reviews and property strategies, property development with and for clients, tax, SMSF, business structures advisory, and cash flow real estate. Everything we do is to help people achieve financial independence and not just basic financial freedom by using property as a tool and as a medium. Presently, we've launched Australian Property Academy, where we are training and teaching buyer's agents, property advisors, property strategic partners, and secrets to finding investor-grade properties to astute investors. Connect now to experience it yourself, or drop in a line below at info@helpmebuy.com.au to get more information. Be kind and happy investing. This episode is all about things that you need to know about the property development lenders and what are they looking out for. In the first episode, we basically talked about the legal entity and their requirements and who's in charge of the project and who owns the project and what accountability sits. We talked in very much detail about the valuations and the feasibilities of the project. This episode is the second part of the first episode, where we are going to take it further down, more things that a property lender looks at when they are going to give you financing. Drum rolls, let's introduce Miss Cheryl. Miss Cheryl, how are you today?
Hello, cool. Very, very well, always. And this is a continuation of what we spoke about on our last episode. So let's dive in. I think you've given a good little roundup there. Let's dive into the 6 other things that commercial lenders, private lenders are going to be looking out for when assessing whether they're going to fund your next deal. Alrighty.
From my perspective, the next thing that a lender looks at is, of course, where's the equity coming from? So they are going to give you a certain portion of the debt, but they'll always ask, okay, where is the balance of the money coming from? Is the developer fronting that money, or is there investors sitting behind this, or is there equity in the deal? And so it's important from their perspective to understand where is that money coming from as well. You have to provide that, surety or guarantee that that money is there.
Yeah, absolutely. And ultimately, they want to be able to see if they're going to be funding, let's say, for example, 65% of the GRV, then that means the other remaining 35%, if my numbers are correct, are going to be funded by your equity. So equity, however, can be in the form of actual cash that you might have available, or if you are very, very fortunate and you've done some amazing things to the land and increased the value, the equity may be actually in the land itself. And that's going to be the best case scenario in that regard. But they're going to be ultimately they're going to want to know where that shortfall.
There's a third way that I've seen people doing this as well, where they put up a collateral against the equity, and they might say, I have this house that is paid off, and I'll bring this as a collateral. I always find it very interesting when people do that, because then you're offering more than what they need in offering them collateral. And that's a mistake 101, where you're bringing in your own assets into the deal. Understand that you're providing personal guarantees anyway. So those assets are technically on the line anyway, but you providing a collateral up front is basically them actively, taking that, property into their own wing. And because, see, there are 2 ways to think about this, right? One is the good side where, okay, your personal properties are protected and you don't need to worry about it. And, you can refinance that money and give that money in cash through the process. And if, God forbid, the process goes down, or the project goes down, then they need to come back looking for that money into your property portfolio, right? And so that gives you an opportunity to hide and protect your own assets and fight a case to not basically give them what they really want. And there is a bit of negotiation that could typically happen. And they say when the creditors are on your door, it's usually 50 cents on a dollar that they would argue and get in the best case scenarios. But when you've offered something up front in collateral, what you have done is now not only you've given them the equity, you have also given them something extra, So for example, if your equity required is say $200,000 and you've given them a house, which is worth $1 million, now they have access to an extra $800,000 that they didn't really needed to have access to, okay? So make sure even if you're bringing that into the deal as an equity funding, there are limits allowed for in that process where you can't get the refinance because of your borrowing caps, whatever. Make sure that, when you are fronting your own personal assets as collateral towards the equity to get the higher LVR, that there are conditions there where it says X amount is only what you're putting up for collateral so that, they cannot take the whole thing, if push comes to shove.
Yeah. Yeah. And I find like in those situations, it is more so a last resort type thing because you don't want, definitely you don't want to have that unless you need to top up equity in whatever situation. And you're, a lot of developers will seek out investors and investors again will want some level of security. So understanding that the equity portion is an area that needs to happen. Lenders need that. There are a lot of different avenues that you can find investment to put into it. This session is not we'll have to have another episode just covering that. But yeah, if you can avoid having security off another one of your properties, that will be preferable because you do have to go through the whole valuation process again for that property to ensure that you can actually access whatever equity is in that property. So it's like a domino effect.
Definitely. So that's number 6. That's number 7.
Oh, it's 7.
Number 8, Cheryl. You can do the honors.
Well, let's talk about pre-sales. Let's talk about, for a lot of lenders will require pre-sales. A lot of lenders also in the current market may not require pre-sales depending on the type of property that you're looking at. So pre-sales will typically be, I say back in the day, a lot of lenders wanted enough pre-sales to cover debt. So I'm not great at saying out numbers without looking at them, but let's just say you're borrowing $1 million and debt is $600,000, for example, and each of the properties that you're selling. Oh no, this is really bad now. Say that you have to sell. Let's say you have to sell 2 properties to cover the $600,000. That sort of gives you an idea of how many pre-sales you might need. That if you're doing a 4 townhouse site, for example, right? So some lenders will need that will give them some level of security in that regard, right? That they're not so overly exposed. But some lenders understand that you might have a product which doesn't do very well with pre-sales. And this might be in the case of, sort of more luxury type stock where in the current market, a lot of buyers aren't wanting to do pre-sales. They're wanting to actually see the project and see the property completed and in its, in all its glory before it gets sold. And usually I'd say that's in smaller scale developments when, you might be doing a duplex style or just a small 4-pack or whichever that might be. Your lender may not really need pre-sales, but if you do have pre-sales, then that's also going to give them, the lender might have some more scope of requiring less equity from you as well.
And I think a lot of bigger banks have quite low risk appetite too. And so you would see major banks always asking for pre-sales versus some of the mid-tiers are okay not doing pre-sales. Also, the size of the project matters to them as well. Whether you are doing 10 townhouses, they'll usually ask for some pre-sales because of the concentration risk. Or the small project like 3 units or 4 units, they might bypass and not ask for pre-sale. So you're 100% right. Looking at that debt coverage some lenders actually take their coverage to almost 110% coverage rather than just 100% coverage, because they want their interest capitalized to be protected as well. And from a lender's perspective, understand what they're doing is they're basically locking in their returns, and they want to be insured the worst case scenario. If there is a bill contract in place and pre-sales in place, they have basically guaranteed their return coming back to them. Yeah. So, and that's the easiest way to think about some of these things.
Yeah, absolutely.
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years, and there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book, it's easy to read, it has a lot of stories, it has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book.
The next one would be, is ultimately like, what stage is the project in? Are we purchasing right when it's just purely land? Are we needing help to acquire the land, or have we acquired the land, put a DA in place, and we just only need it for the construction phase?
Yeah. Look, from a lender's perspective, it's always important as to where the project stage is, because they find it extremely frustrating if a developer reaches out to them at an acquisition stage, because they're like, well, there's too much risk. We don't want to come in right now. Unless you are planning approved, we can start talking about it. And then, the building approval and the development approval, typically comes in following that, and they would start engaging with you. In an ideal scenario, they want the project to be build ready. And so they want the development approval in place with you going towards the building permit stage. That's where a lot of lenders would want to basically be engaged, and work with you along that side, because they know that now you're serious in, taking this to the next level. So yeah, it's important to understand what stage you're in. And also, like, from a lender's perspective, they might do the deals where, they'll fund the acquisition and the construction finance, but they want to ensure that at least the DA is in place, or at least the planning approval is in place. There are different terms between different states. So they want to ensure that the planning approval is there before they put their neck on the line and, give you any sort of funding. So that's very, very important.
Yeah, the more that you can, I guess the whole idea is de-risk the project, the more that the land is going to be more comfortable. And this whole process of what we're talking about is around the lender's risk management policies.
Definitely.
Basically. We're looking at the project, we're looking at the people that are running the project, we are looking at the stage of the project that it's in. And the more advanced, I guess, that the project is in, and it's jumps through all those risk hoops, the more that the lender is going to be more open to actually fund it. Yeah, absolutely. We've got absolutely. We got three more questions to go on. What's the next?
The next one is
not question.
The next one is the builder and the relationship with the builder and the nomination of the builder. The builder plays a really, really important part when it comes to the construction finance. A lot of people think that builder does not play an important part and they can nominate a builder later in the process. But that's never the case. The experience of the builder is always challenged and questioned when it comes to development deals, especially on the bigger development deals. They want to make sure that the builder has done something like this before. Sometimes they'll trigger 3-party agreements with the builders where they would want builders to take some risks. And I've seen deals falling through, where builders refusing to sign some of these 3-party agreements as well. So tri-party agreement is typically what they're called. So yeah.
Yeah, and we've come across that situation as well. And the tripartite agreement, that's probably something that we can address in another episode. But what the lenders will look at is the builder's financial capacity. So we'll look at their finances. As you know, we've had quite a terrible time over the last few years with builders, a lot of them going bust, going into liquidation. So financiers want to make sure that you're engaging a builder whose finances are solid. They'll ask for the builder's insurances. Home, if depending on the size of the project, that might be proof of home warranty insurance. Ultimately, they will want to look at the build contract itself, and to ensure that to a certain extent that you are factoring the contract is factoring things like, when you're doing your drawdowns, are you okay to engage a quantity surveyor to do all these? Do you have sufficient liquidated damages? What is it clear when those drawdowns are done, or is it too ambiguous? So, it might seem that there's a lot of requirements from the financier for this sort of information. But like I said, if they're lending you millions and millions of dollars for a project, which ultimately projects are risky, right? They're going to want to make sure that they're preserving their funds and their investors' funds as much as possible. Yeah. So the more that you're able to even allow them, have them be able to speak to the builder to get an idea of whether the builder has the processes and the experience to do this, they're going to have a lot more comfort in
and I think
money.
it works in developers' favor to grill down builders into these directions, right? Understanding their cash flow and their financials, because a lot of developers don't have any idea as to what the builder's risk appetite is or how exposed they are. So it definitely works in your favor. I think where it gets really interesting is where the developer is part of the JV agreement and they're doing cost plus bills and, all of the interesting agreements where, now, of course, they want the builder to be at an arm's length person and a third party to the contract and not a party to the profits. And so that's why it's always important to drive or draw a really clear line on some of these things, because lenders hate developers who are part of the JV agreements as part of the profits as well, or cost plus agreements. They don't really like them. They want builder to be person standing completely outside of this ecosystem and just providing a service, fee for service. So yeah,
it makes it easier. It makes it easier for them. Not that it's impossible, it just makes it something that they're more comfortable with.
Definitely. And there are some, brokers and lenders out there who play in this space and have the appetite to, provide funding for, developers who are, party to the project as well. And there is nothing wrong with that too, provided that, the risks are capped and you're managing the risks efficiently.
Yeah.
Next one, second last one, Cheryl.
Second last, we always we want to go first, but in second last we'll sort of do. How are we exiting? So what's the exit strategy? Ultimately, the financier wants to know how they're going to get their money out.
Yes.
So are you going to sell all of this, or are you going to hold and refinance?
Yeah.
And you've got to get a clear, and this is why they do some, this will go back to the valuation, is to understand whether at the very end of the project, whether there is a good chance that they will get all their money back in their pockets, payable with interest as well. So
my suggestion,
sort of get really clear with them.
My suggestion to people always is that always assume an exit strategy to the project, and that exit strategy should always be sell, because then you truly understand your walk away profits for the deal. You exactly know post GST, this is what you're walking away with. The whole strategy is where you're not paying the GST and you're not paying the selling price or the marketing fees, etc., and dropping them into the profits for you to basically use it into the future. It does not truly show the true profits of the project. And so potentially lenders are looking at it from that perspective as well. And so when you are going to anytime say to the lender, I'm going to hold some of these assets, your servicing or your borrowing capacity would always come into question. And so they'll start assessing your borrowing and start seeking rentals or rental appraisals for the finished product as well, because they'll want to see whether the rent and the borrowing is enough for you to hold on to these properties. So, keep it simple. Always say sell, and sell is the strategy. And then if you decide to hold, that's fine. There are residual finances available to you, and you can go down that path and move the properties. But, keep it the discussion very simple from a lender's perspective, that your strategy is an exit strategy to sell, so that, there is not too much back and forth when you're going through this journey or this transaction.
Yeah. I mean, in saying that and the situations and why I want to sort of challenge that to an extent is if the product that you have is a buy and hold, because there's going to be, do I apply GST or not? Because GST is a big chunk as well. And so there are going to be situations where the fact that you actually are not part of your feasibility is because I want to be able to not pay the GST, because this is, for example, is a long-term hold, like a co-living or whatever that might be. For people, that part of the extra 10% as well that you're saving on the GST portion is going to be a fair part. They don't have to pay for marketing, and the whole lot of costs you don't have to pay. You're saving a whole maybe 10, 15% as well. So, I get the point of doing the numbers for selling, but for some deals, like if they're long-term holds, they might not actually make sense if they were to sell it, because it makes more sense for them to hold it.
Yeah. And look, typically if you're going to sell them and it's a loss-making asset, then of course the funder would not, lend you the money, right? And so I agree, it's a catch-22, right? Where the deal does not have enough profits for you to make an exit strategy is sell, then you are going to go do the development to hold.
Yeah.
You just need to ensure that there is enough borrowing capacity, for example, for co-living properties, where, there is enough cash flow coming from the deal for the lender to be safely saying that you can transition this from a commercial loan to a residential loan in the future, because there is enough cash flow coming out from the product.
Yeah, absolutely. The last one, lucky last. What would be the last thing that the lenders would look for? Ross, go ahead.
Project duration is one of the key things that a lot of people tend to almost bypass, because they're very dependent on the builder to say, the builder is at 12 months, so I need the loan for 12 months. The lender understand that, from a lender's perspective, it's all about cash on cash return, right? And so they're looking at annualized returns so that they can take a clean exit and bring this money back, because they are using, especially private financiers, they have people with private money who have basically invested into these projects. So they need to go back and show them what returns have they achieved for these people, rather than just, locking them into the project, right? And so sometimes it can become really tricky, where the duration of the project would trigger different LVRs or different returns that the private equity lender would offer you. So it's important that, you are articulating that duration of the project quite well. So if the builder is saying 12, you probably go for 16 or 17 to give yourself a buffer. And you can roll off your loan earlier. There's nothing wrong with that. Yeah. But, have a bit of buffer in place on a lot of these things and plan it accordingly. Builds do take time, and there is weather. One thing that COVID has taught us, there could be construction issues and supplier issues together with weather issues and labor issues. So make sure that, you have a bit of leeway when it comes to project duration, and you're articulating it very correctly to the lender as well.
Yeah, and always put in a buffer.
Yes.
Always put in a buffer, your contingency. So your contingency in your finances, to make sure you've got at least 2-3 months of contingency at the back end of the project as well, because it's going to cost you less. You're better off saying to a lender that this is, if you're in your mind, it's probably going to take 12 months, you'd add another 15 months, have it in there for 18 months.
Definitely.
It's going to cost you more. If it's going to cost you more from retained interest, make sure that the lender allows you to, reduce the amount of interest payable if you finish earlier.
Definitely. I think that's
a better outcome for you than rather having to extend the loan or to go in default, because it's going to cost you a lot more. And I say this from experience, it is incredibly painful to go down that path.
It is. And I think one of the projects that, is, coming towards then now, we've sold 2 and there is 8, or there are 6 more that are ready to be sold, and we are just hit lock up on that. There was a very interesting conversation that I was having with the lender, and they're like, well, the builder is very confident that he'll finish in 14. And so just take 14. And I was like, no, but I need at least 18 months. And so they're like, but why do you want to pay all of this extra? And their establishment fees against past 12 months, and we can extend it to 16, but not 18. And so there was a lot of to and fro. And a lot of people could not understand why was I asking for that buffer. And I'm happy to pay that extra money. And, typically the walk away was that, okay, you're going to go with 16 in the contract with an opportunity to extend it to 2 months if the need be. And we'll pay all the fees, but that opportunity sits with me making that call. And so that was the level of comfortableness. And so while the builders might be running really fast and they are, doing an amazing job, you need to have the buffer on the hand. You can't just go, eyes closed in some of these things. So, yeah.
Yeah, absolutely. Okay. Anything to add before we wrap up with some, the good bits, right? Everyone's been so good waiting to the very, very end. Let's dive in.
And so this is an interesting one. And I see a lot of people getting caught out by this. And, in early days, I've been caught out by this too, because, you are, an aspiring builder. I don't call them knob or newbie builder. I'll say aspiring builder. And you're going down the path of, acquiring a property, with the bank. And so, you've done all the work and you've set up the trust right. And, you've signed the contract, etc. But there are little things that basically triggers the bank on certain things. And so understand, as an aspiring developer, you might buy a raw site which has no plans and permits, and you'll, rent it out for maybe 6 months or 12 months while you put the plans on them. And then you will take them towards the construction finance. And so your journey usually starts with a traditional bank, where you would, typically acquire the site only for investment. And that's what you're going to claim to the bank. Oh, this is just an investment property. And yes, it's negatively geared, but it's just an investment property. And then you do a bait and switch to the bank 1 year down the track saying, hey, by the way, I've done the plans now and I'm going to do the development. Okay. Now, very common for people to transition into development. And even some of the more successful developers do that. And the banks know this too. And banks do put a blind eye to some of these properties. There are certain things that you can't trigger when you are following this strategy. And the first and the foremost that we called out before as well is, they don't name your company or the trust as XYZ Development Trust or X, Y, and Z, development company, because you are signaling to the bank at that given point in time that you are going to do a development. Okay. It's very common in Victoria where you can nominate the contracts out, right? And so, and I'll share my story where, I bought it under my name, Moxin Reza, and /or nominees. And then, I could nominate it out to a company or a trust to, settle the property. And when I, brought that property in, or when I brought that trust in, I had, X, Y, and Z property trust, blah, blah, or property development trust. And then as soon as you go to the bank now, I'm like, wait a minute, you said this is an investment property, but, why does it say property development? Just because of the name. And then all of a sudden, the hell breaks loose because you are from the settlement, you had a pre-approval in place, and then now they don't want to settle because they know that you are going to develop this.
There's like a lot of bad memories flooding back, Moss.
It is. And it was like, it's a shock to the system, right? Because everything basically stops in the mix of, what you're trying to do and what you're trying to achieve. And so, how do you pivot? And, what we ended up doing was, quickly change the trust and went to another lender and, got the loan approved, etc., all of that. But a lot of people do not know and they cannot move and they freeze in some of these situations. And so the best scenario is to not go down that path and, not call your trust some of these, crazy names. And one of the things that developers do all the time is they'll always name their trust with the street names or names. And again, it's not a good idea, for a first-time developer to do that, to have, street names in there, because, the banks realize that, you're going to do developments there. So that's number one. Number two is when you are going to buy a land-only deal where you're going to do plans on it, understand that because there is no investment attached to it or there is no house attached to it, it would always attract a very low LVR to a certain extent only up to 50% LVR. Okay. A lot of people don't know that, and they get caught by this. And so while they might have a pre-approval of 80%, as soon as they bring in this property and they'll think the broker would say, hey, that's fine. You have a lot of servicing, blah, blah, blah. You go and, try to get the finance, and all of a sudden you require a lot more equity than what you originally projected, because the LVRs to that particular product, sits at 50%. So don't be caught out by some of these deals. Some of these deals are too good to be true because they are land-only deals, because there are certain that the previous developer has done that they shouldn't have done. The third one is the plans on the property. And so again, it gets very exciting where you have plans on the property and you think, oh, this is ready to go and I can do the development right away. And majority of the times, these would be just planning approvals and not building approvals. And in Victoria, say, for example, it takes almost 6 to 8 months for you to go from planning approval to building permit stage, okay? And your settlement might only be 2 or 3 months. And so you can't, even though there is a house on it, you can't settle this house as an investment property anymore because there is plans on it. And so a lot of developers get stuck there when they are trying to sell this site to a normal person and a normal investor, because they can't buy it because the bank says, well, there is plans on it. It needs to go down the commercial route. It cannot be in the residential space. It's these things where you need to be really careful and think about them logically and, ask the right settlement terms, ask the right questions, go speak to your broker, go speak to your accountant, making sure that you're significantly risk mitigating yourself when you're going into these, deals as an aspiring developer or a transitioning developer.
Yeah, absolutely. And these are things, like I said, having the house on the land, these are all things that you may not really even think about when you're starting out until someone says, go and knock down that piece of land.
Yes.
No matter how terrible.
Garbage, just keep it there. Yes.
Yeah, no matter how derelict and how terrible it looks, don't knock it down, because it ultimately reduces the price and the LVR as well substantially. So these are sort of really good little golden nuggets to wrap up this last episode. Remember, this is part 2. Listen to part 1 so you can hear the whole episode in its entirety. They've highlighted 12 key points that your commercial lender or your lender in general, your financier, is going to want to get from you to assess whether they will be funding your deal or not. And it's been an absolute pleasure, Moss, as always.
Thank you.
Doing these sessions with you. I hope these were helpful. If whoever's listening, if you have other things that we've missed out and you think that is really important to add to our list, please let us know.
Thank you very much. Cheryl has done an amazing job wrapping this up. So keep smiling, keep investing. Take care and be kind. This is Cheryl and Moss checking out. Adios.
Take care. Bye-bye.